If you're tired of paying your landlord's mortgage and want to achieve the goal of home ownership, you've come to the right place. Hi, my name is John Charbonneau. I'm a mortgage professional with TMG, the Mortgage Group, and I will be your host for our first-time homebuyer webinar. For many Canadians, home ownership is considered a sound investment, and for the majority, it represents the pinnacle of personal and financial success. Purchasing a home can also seem daunting and overwhelming. It's probably the biggest emotional and financial investment decision you will ever make. Before you start looking at homes, you'll want to do a bit of homework. Our webinar will provide the early insights you need to have a successful and enjoyable first-time home buying experience. As promised, we'll have 4 presenters: a realtor who specializes in working with first-time home buyers, a home inspector, a lawyer, and myself talking about mortgages and getting pre-approved. On this screen, you'll see a comment and question box. We encourage you to send us your questions. There's a good chance we'll cover your questions in the material we have prepared. If we don't have time to get to your questions during the webinar, we will get back to you by email with an answer. Our first presenter is Gina Fraser. Gina has been a RE/MAX realtor for over 20 years and has a passion for helping first-time homebuyers achieve their dream of owning their first home. Gina brings a wealth of real estate knowledge and an in-depth understanding of how to help first-time homebuyers navigate the home buying process. Let's get started and welcome Gina Fraser.
Thanks so much, John, and welcome to all of you. Thanks so much for joining us on this webinar. We're going to tackle the real estate component of buying a house, so there's a ton of information that I'd like to cover. So let's just jump right in and get into the PowerPoint and enjoy the presentation. Okay, so what I've created is a Buy Smart home buying system. And the reason that this came into being was, having done literally hundreds of home buyer seminars, it became really apparent that for most home buyers, and particularly first-time home buyers, the whole process is incredibly overwhelming, incredibly stressful, and I could see that what buyers really needed was a compact system that laid everything out, made it clear, so that when you get to your home buying process, you will know exactly what to expect and know exactly how the whole process should work. And that is the Buy Smart home buying system. Buy Smart is an acronym, and we'll go over a letter for each one, and you'll see how this works. So B is, we want you to begin as the CEO of your own company, Buying My Home Inc. This is really, really important because you really do have to look at the home buying process as something that you are in charge of. You have to take the time to assemble the team of people who you are fully confident are going to take care of your best interest and help you through the process. And, you know, sometimes I tell people I see people take less time picking their hairdresser or going to buy a pair of shoes and picking a pair of shoes. They seem to take more time and effort into that than they do in picking their mortgage broker or picking their realtor. So this is a real critical part of the process. You need to begin as CEO of your own little company called Buying My Home Inc. You need to assemble your team, and who are these team members? First, you want to have a mortgage consultant, and John will be talking all about that a little bit later. But your team will consist of a mortgage consultant, a realtor, a home inspector, and a lawyer. Now, there may be more people who come into the picture, but these are the 4 people who almost every home buyer will have to have working with them. And this is going to be your team. So let's find out what to do next. You in Buy Smart is understand your financing. I'm not going to spend too long on this because John is going to go into that in a lot of detail, but I just want to reiterate right at the front here that getting pre-approved first is a must, and John will explain why, but you have to get pre-approved first. You have to know what you can afford before you even look at a single home. Too often I've seen buyers go through the process, and if they don't do this, they end up looking at a home, they fall in love with it, and then they want to write an offer, and they find out after the fact that they can't even afford that home, and they're very disappointed and frustrated. So Find out what you can afford first, and you'll then find out what your monthly payments will be, and those monthly payments are critical because that's what you base your monthly budget on. So John will go into that in a lot more detail, but you have to understand your financing. Why is you select a realtor, and what your realtor will do or must do is represent only your best interests, demonstrate their market knowledge and expertise, treat your money as if it were their own, and make you feel like you are their only client even when you know you are not. And this is really, really important because your realtor, if you don't have a relationship of trust with your realtor, you're going to second guess everything along the process. So you have to not only trust your realtor, but trust their knowledge of the market and their expertise as well. And we'll go a little more detail in that in a minute or two, where I'll give you some very concrete things to do to help you in that process. So you select a realtor. How do you do that? Most of you probably have not worked with a realtor often or at all. So it's sort of a situation where you don't know what you don't know. There's over 9,000 realtors in the Greater Vancouver Real Estate Board. And I'm going to give you a little interesting statistics now to kind of give you an idea of what the real estate landscape is like. So there's over 9,000 realtors in Greater Vancouver and more in the Fraser Valley. If we would take all of the 9,000 realtors and try and figure out on average how many transactions each of those 9,000 realtors does in the course of a year, and we'll use 2012 was the year that we figured this out for, we found out that on average each realtor did 8 transactions a year. Now that doesn't sound too bad, but it got really interesting when we took the top 25% of those 9,000 realtors, and the top 25% of the 9,000 realtors did about 15 transactions per year. Quite a difference. The other 75% average 3 transactions a year. Why is this important to you? Well, if you're going to have a realtor who is going to represent you in the largest single purchase you're going to make in a lifetime, I think you can see the importance of having someone who negotiates more than 3 times a year. It has nothing to do with, working with top producers or #1 people. It's all about how much experience they have negotiating transactions and how their market knowledge is, and that's directly reflected in how much business they do. So we've already talked a little bit about this. Your realtor negotiates on your behalf. What a lot of first-time buyers don't realize is that when you find the home that you want to purchase and you sit down with your realtor and you write an offer or a contract, your realtor then takes that offer on your behalf and goes to negotiate with the listing agent and the owner of the home, the seller. You're not at the negotiating table at all. So you are putting an awful lot of trust and confidence in your realtor because they're doing the negotiating for you. You don't see what's going on. So you have to have incredible confidence and trust in your realtor's negotiating skills. I think you can understand then why it's important that you want someone who's negotiated more than 3 times per year. Just like if you were having maybe a loved one having open heart surgery, you'd want to have that with a surgeon who does more than 3 open heart surgeries per year. So strong negotiating skills and experience truly can make the difference between thousands and thousands of dollars, and I've seen it happen time and time and again. How do you choose a realtor? You probably haven't interviewed many realtors, so you don't even know what to ask. And you should be interviewing a potential realtor and asking them specific questions. This is such a crucial part of the process that I decided to create a free interviewing guide called The 10 Critical Questions You Must Ask Any Realtor Before Working with Them. And I'll tell you how you can get your copy of that guide at the end of this presentation. Another interesting point when you work with a realtor is that it doesn't cost you any out-of-pocket money. Some people don't realize that. They think, well, if you have a lawyer working for you and the home inspector doing an inspection, you'll get an invoice once they're finished their work for you and you have to pay them. And that is true. With a realtor, that doesn't happen. You do not pay your realtor anything out of pocket. And so that begs the question, of course, why wouldn't you have your own realtor working for you and your best interests? The S in Buy Smart is start looking at homes the right way. So we're assuming now you've been to your mortgage broker, you've been pre-approved, you've selected a realtor who you're fully confident in, and now you're ready to start looking at homes. But you want to do it the right way. And what does that mean? I call it you must have a list of your must-have features. These are things that are non-negotiable. They could be a specific price range. You don't want to go any higher than a certain price point. Or you absolutely want to live in a specific neighborhood. Or you have to have a certain number of bedrooms. This must-have feature list are things that if a home does not have it, no matter how perfect the home is, you don't even want to look at it. And it's this, I call them deal breakers on this list. Items that if the house does not have it, you would not even be interested in seeing it. And this is the list that I use, the must-have features. When I send my clients new listing information, I only will send them listings that have these must-have features. Then you want to make a second list, a list of what we call would-be-nice features. And these are things that you'd love to have: a south-facing backyard maybe, a den or an office, a double garage. Your perfect home must have all the must-have features, and you'd like it to have as many of the would-be-nice features as possible. So you want to be really clear on these two different lists. And it can get interesting sometimes because a husband and a wife might come up with two different lists that have a few discrepancies, and you have to make sure that you're both in agreement on what the must-have features are. You need to hear about new listings as soon as they hit the market. And you can't get this information yourself. Now you might be asking, well, of course I can. I can go on the internet. Well, just bear with me here and you'll see why this doesn't work. What I'm going to show you now is what happens when a house is listed. On day one, I go into a home and a seller gets me to list their home for sale. So I do all the paperwork. Then on day two, I hand in all that paperwork to my office and they send it to the real estate board. Then on day three, the listing hits the realtor's MLS. All 9,000 realtors I spoke about earlier, they now know about this new listing. Then what happens is on about day 6, the listing hits the public MLS. That's a 3-day delay. The public MLS is where you are visiting to look at new properties that get listed, but you're not hearing about them until about day 6. And what do you think has happened if it's a great listing, priced really well, and you find out about it on day 6, and you phone the realtor about it? What do you think you might be told? You might be told that it already has an accepted offer. For those few people who probably are still looking at print ad and are looking in the Real Estate Weekly, you might see the first ad about this great new listing on day 11. And of course, a first open house probably wouldn't happen on day 14. So you can see if you're relying on the public internet, you won't know about the new listing until it's actually 6 days on the market. And print ad day 11, and there's a strong likelihood that you will be told the house has either sold already or has an accepted offer. So this is why your realtor must have a system for letting you know about new listings the day they hit the realtor's MLS. And that way you're finding out about these new listings the same day as all 9,000 realtors. The M in Buy Smart, make the right offer on the right home. You must never feel pressured into writing an offer. If you do, you're working with the wrong person on your team. You have to feel comfortable looking at as many homes as it takes, and this varies from person to person. And really important, the first time you see the contract of purchase and sale should not be when you're writing an offer. You should be comfortable with that document well before, so that when it comes time to writing an offer, you can focus on the things that are important, such as all the details you're going to put into the contract. A in Buy Smart is attention to all the details. And really, there are hundreds of document pages in every real estate transaction, as well as probably hundreds of phone calls. And if there's strata documents, if you're buying a townhome or a condo, there could well be nearly 1,000 document pages in every strata transaction. As I mentioned, contracts, addendums, title search, inspection reports, strata documents, appraisals, mortgage documents. If there's a mistakes or sloppiness in any document, it truly can cost you thousands of dollars and add such unnecessary stress to the process. R, ready for moving day. Our goal is that there were no surprises for you. Everything went smoothly. Your team did not disappear after the contract was firm, as many buyers complain about. They say their realtor disappeared as soon as the contract was written. That should not happen. You would have received a checklist and a timeline to follow for everything that needed to be done before moving day. So that, when we get to T, time to move in, you had a great home buying experience and the moving day went smoothly. And it's now time to begin making memories in your new home. When asked by friends and family about your moving experience, you might reply, with the BuySmart system, it was fantastic, enjoyable, and worry-free. And that truly is our goal in this, is to give you an enjoyable and worry-free home buying experience. So I told you I'd tell you about the free report that you can get from me. I wrote this called The 10 Questions You Must Ask Any Realtor Before Working with Them. And it's really easy. If you'd like to get your copy of this document, all you have to do is send me an email. The email will come up on your screen to ginafraser@telus.net, and just mention the 10 questions report or something like that, and I will get that to you so that you can see all the important questions that you really need to ask any realtor before working with them. Thanks for joining me on this segment, and now back to you, John.
At this point, I get to switch hats from being your host to that of being your mortgage broker. For many first-time home buyers, the role of a mortgage broker might be an unfamiliar one. So let's take a moment and review what my role in the home buying process is. In short, I'm the money guy. You meet with me, we look at what your home buying goals are, and I make the arrangements to have your financing approved. I deal with banks, trust companies, credit unions, life insurance companies, and pension funds, all of which provide various types of financing. My job is to find the best mortgage for your needs, get a highly competitive interest rate, and show you which lender has the best product for you by showing you how their offerings compare with regards to penalties, prepayment options, and how the fine print from one lender to another can make a huge difference in the long-term cost of owning a home. One of the best parts of dealing with me is that my fee is paid by the lender. So working with me does not end up with you paying me a fee. In short, I get paid by the lenders to offer you their best interest rates and terms. With that out of the way, let's get started with the financing process of buying your first home. Let's talk about your first challenge, saving for a down payment. Once you decide that home ownership is in your future plans, you'll want to set up a budget so that you can begin to save money for a down payment and to cover closing costs. A down payment is the portion of money that you will contribute towards the purchase price of your home. Saving for a down payment is a crucial step towards home ownership, and it will help you prepare for the financial obligations that are associated with it. The more you contribute to the purchase price, the lower the amount of mortgage financing you will require. And with a lower mortgage comes a reduction in interest paid to your lender. There are two primary types of down payment: money you have or will save, and money that is gifted to you by a family member. First-time home buyers should try to set a goal of saving between 5% and 20% of the purchase price. There are a number of government incentives. Let's talk about a current government incentive for first-time home buyers with respect to down payment. It's called the Home Buyers Plan and provides assistance for potential buyers to realize their dream of home ownership. It allows you to use your RSP for part or all of your down payment and to assist in covering closing costs. Qualified applicants can withdraw up to $25,000. Applicants have 15 years to repay the funds back into their RRSP. Applicants must be residents of Canada. Applicants must have an agreement to purchase at the time of the withdrawal. Money withdrawn from an RRSP under this plan must be on deposit for 90 days prior to the withdrawal. At any time, an applicant can repay any outstanding balance without penalty, and the funds must be used to purchase a primary residence for the applicant. The amount of your down payment determines the loan-to-value ratio. The loan-to-value is the amount of the mortgage loan compared to the value of the property. Typically, lenders will limit the loan to an amount less than 95% of the value of the property. Loan-to-value ratios are used by lenders to determine whether or not you will qualify for the loan, and if the loan will be classified as conventional or high ratio. Conventional mortgages have a loan-to-value ratio of 80% or less of the purchase price, and high ratio mortgages have a loan-to-value greater than 80% of the purchase price. If you are borrowing more than 80% of the purchase price, you will have a high ratio mortgage, and it must be insured so that the lender is protected in case you do not make your mortgage payments. Currently, there are 3 high-ratio mortgage insurance companies available in Canada: Canada Mortgage and Housing Corporation, CMHC, Genworth Financial, and Canada Guarantee. High-ratio insurance is often referred to as mortgage insurance or mortgage default insurance, and should not be confused with home insurance, which you can obtain on your own to cover the cost of the loss of your property or contents due to things like theft or fire. The mortgage insurance premium can be paid in a single lump sum when you close your mortgage, or it can be added to the principal balance and paid off as part of your mortgage. The insurance premiums are identical from one insurance provider to another. Each of the 3 insurers provides different policies and guidelines. A mortgage application declined by one insurer may be approved by another insurance provider. Not all lenders deal with all 3 insurance providers, and this can result in one lender turning down an application, but the same application presented to another lender could result in an approval. In addition to putting together a saving strategy, it is important that you establish and maintain a healthy consumer credit history. Your credit report will show the lender how you handle debt by providing information on how much credit you have and if you are able to make your payments on time. Your credit report is created when you first apply for credit or borrow, and it is tracked over time. The information is collected and maintained by credit reporting agencies, also known as credit bureaus. In Canada, there are 2 major credit bureaus, Equifax Canada and TransUnion Canada. A credit bureau may provide credit information via a report referred to as a credit report, and will provide a lender with a 3-digit number as an overall evaluation of your report and is called a credit score. Since your credit report provides an overall picture of your financial history, lenders and credit grantors will request a copy when determining whether to lend you money or grant you credit. Any negative information may adversely affect your ability to borrow money or obtain credit, so it is important to maintain a healthy credit history. Making your payments on time for all loans and credit you owe will contribute to your credit worthiness and present you as an attractive borrower to lenders. Generally, the higher the credit score, the lower the probability a borrower will be delinquent on payments of credit granted. The credit score is based on a statistical formula combining personal information from the credit report and other sources to arrive at a score ranging from 300 to 900. For those borrowers with less than a 20% down payment, the credit requirements have increased over the past couple of years due to the Federal Minister of Finance in Ottawa implementing policies to reduce the number of riskier loans offered by lenders in Canada. Loans that were commonly approved only a few short years ago are now being declined as a result of borrowers not having high enough credit scores. It is worth noting that it is a wise idea to review your credit to make sure the information is correct and to take the time to correct any errors that negatively affect your overall score. You are entitled to receive a free copy of your report by mail from each of the two major agencies. Reviewing your credit is something best done in the early stages of the home buying process, so that you have time to make changes either by correcting mistakes or improving payment history and your overall score. How much home can you comfortably afford? Before you head out with your real estate agent to look at homes, you need to determine how much home you can comfortably afford in total monthly housing costs. Your affordability depends on your income, your down payment amount, mortgage interest rates, and any other financial obligations you may have. The amount you can afford as a mortgage, plus the money you have saved for your down payment, will determine the price of property you can afford and will help you and your real estate agent focus on homes in your price range. To determine how much mortgage you qualify for, lenders will use two simple qualification ratios: the gross debt service ratio, GDS, and the total debt service ratio, TDS. Let's look at these ratios in greater detail. Gross debt service ratio includes the principal and interest component of your mortgage payment, property taxes, an allowance for heating, and 50% of the maintenance fees for condos. Provided all other conditions are met, lenders can allow a borrower to use up to 39% of their gross income to service the debt of a mortgage payment, property taxes, heating, and 50% of the monthly condo fees where applicable. In addition to the GDS ratio, a lender must consider any other monthly debt obligations for repayment of such items as credit cards, car loans, and student loans. When the repayment amounts are added to items included in the GDS, the total debt service ratio should not exceed 44% of the applicant's gross income. The ratio of 39% GDS and 44% TDS are considered the maximum allowable ratios acceptable to the high ratio insurance providers. This does not mean that every lender would approve a borrower to take on the maximum mortgage under these guidelines. To be approved for the maximum mortgage, a borrower would need to meet additional criteria such as income stability and credit history. The most important thing to take away from the discussion of affordability versus qualification is that a borrower might be approved for a mortgage larger than which they can actually afford. The best advice in this area would have the borrower prepare a monthly budget representing all expenses associated with their lifestyle and include amounts for food, clothing, entertainment, and vehicle expenses, to name a few. Once all lifestyle expenses are deducted from the applicant's net take-home pay, the amount remaining could be considered a reasonable budget for housing expenses. In this next section, we will review some basic mortgage terminology. A mortgage is a legal document by which a borrower pledges property to a lender as security for a debt. When borrowing money by way of a mortgage, the borrower will have the option of determining which method of borrowing works best for their individual needs, subject to overall qualification. Let's review some of the basic definitions. A closed mortgage, a mortgage with a fixed contract length. This type of mortgage will allow for partial prepayments over and above the regular payments without penalty. However, to pay this type of mortgage in full before its duration is over will involve a penalty. A closed mortgage will have a duration from 6 months to 10 years in length. A closed mortgage may have a fixed or variable rate of interest. Open mortgage, a mortgage that allows a borrower to repay any or all of the outstanding balance at any time without any form of penalty. An open mortgage may have a rate of interest that either fluctuates during the term or is a fixed rate. The length of contract will range from 6 months, 1 year, 3 years, and 5 years in duration. Interest rates come in two varieties. Fixed rates. The interest rate is set for the duration of the term of the contract at an exact amount. Variable rates are also known as adjustable rates or floating rates. A formula is created, and each time the prime lending rate changes, the interest rate for the borrower's mortgage will change by the same amount. Two final definitions. Term. This refers to the length of your contract. Terms range from 6 months to 10 years. The shorter the term, the lower the interest rate. Amortization. This refers to the total period of time you have to pay off your mortgage. First-time home buyers will typically start with an amortization of 25 years. Until a few years ago, amortization periods up to 40 years were available. However, these were recently discontinued as a result of the federal government tightening mortgage rules. The longer you amortize a mortgage, the lower your payments. But the longer you amortize your mortgage, the more total interest you pay your lender. Once you feel comfortable with your decision to go home buying and have a better idea of how much you can afford, the next step is to qualify for a pre-approved mortgage. A pre-approval is contingent upon the information you provide being verified by the lender. This is typically not done until the borrower has an accepted offer, and that offer will likely be subject to obtaining financing. This is referred to as a soft pre-approval. The disadvantage of a soft pre-approval is that the lender might interpret your documents differently than you have indicated on your application. A smaller amount of income might be used by the lender, and the mortgage amount you thought you were pre-approved for may end up being less than you need. The best alternative to this is to arrange a hard pre-approval. At the time you submit your application, a complete list of supporting documents are provided, so there is mutual agreement on the amount you are approved to borrow. During the pre-approval process, a major decision has to be made by the borrower. This major decision will revolve around selecting the terms of the mortgage. Will you go with a short-term, lower interest rate product or a higher interest rate for a longer term? Will you select a mortgage product where the interest rate is set for the term or may increase or decrease during the term? This is a critical process, and a mortgage professional like me can assist you with a thorough review of the pros and cons of each option available to you and provide recommendations based on your individual abilities and risk tolerances. Once a pre-approval is arranged, the borrower can take advantage of the following benefits. It offers confidence and peace of mind when house hunting. It enables the borrower to search in a specific price range and protects the borrower for up to 120 days in the event that interest rates increase. It is vitally important to remember that a pre-approval is not a guarantee of financing. Even if you have provided all of your income and down payment documentation to your lender in advance of making an offer to purchase. Ultimately, the lender and high-ratio insurance provider, if your down payment is less than 20%, must approve of the property you are purchasing. Some properties might not be acceptable to the lender. It is important that you be aware of this when making an offer to purchase. A standard procedure is to make an offer subject to approval of a mortgage on specific terms. The following will outline the documents required to have your mortgage approved. While some lenders may not require these documents until you have an accepted offer, a wise practice is to review these documents with your mortgage broker or lender at the time of applying for a pre-approved mortgage. Documents for employment and income verification will consist of the following: a letter of employment, current pay stub, and your most recent T4 slip. For applicants that are self-employed, a lender may need to see your last 2 years of tax returns, notice of assessment, and company financial statements. To document your down payment, copies of your bank and/or investment account statements covering the last 90-day period, a copy of a gift letter outlining funds that are being gifted from related parties. Your mortgage broker will compile all the necessary information and prepare a professional presentation to a lender on your behalf. One primary function of a mortgage broker is to locate funding for mortgage financing and to seek the best possible lender package to suit your specific situation and needs. Many homeowners, inexperienced in knowing what to look for in a mortgage, fail to see past the interest rate. Homeowners focused on just getting the lowest rate may fail to obtain a mortgage that is better suited for their needs with features and benefits that will ultimately provide for a lower long-term cost of financing. The majority of homeowners intend on paying off their mortgages as quickly as possible. Reducing the number of years until your mortgage has been paid off will reduce the total amount of interest paid to your lender and reduce the long-term cost of home ownership. All commercially available mortgages will have several different options available to pay your mortgage off faster. Each lender will have different options, and a professional mortgage broker can assist home buyers by not only negotiating excellent interest rates, but also ensuring that the right mortgage is chosen, thus allowing the borrower to take advantage of their ability to pay off the mortgage as soon as their cash flow allows. Here are a variety of techniques to pay your mortgage off faster than the initial amortization period. You can make accelerated biweekly payments, round up your payments to the next $50, double up your payments when available, and make annual lump sum payments on the balance of your mortgage. That pretty much wraps up our financing section. I have 2 additional resources available to you. One is a booklet entitled Home Buying Step by Step. It's a great consumer guide and also workbook. And for those of you that are looking at buying condominiums, whether they be an apartment style or a townhome style, we have the Condominium Buyer's Guide. To receive a complimentary copy of either or both of these booklets, feel free to give me a call at 604-818-2840. Although the process of buying a home can be overwhelming and daunting, the end goal of home ownership is well worth the effort and investment. I hope you have found this section on financing both informative and easy to understand. With the right knowledge, I believe you will be better prepared to join the millions of homeowners in Canada in finding, financing, and eventually owning your home mortgage-free. My personal philosophy is that there is no such thing as a stupid question when it comes to financing your home. So feel free to call or email me if you have questions about financing your first home purchase. And with that said, it's time to look a little further down the road on the way to achieving your goal of home ownership and envision that you've been pre-approved, found a home, have an accepted offer. Now comes the home inspection. Our next presenter is John Schiffer, owner of Quality Home Inspections. John's been a home inspector since 1995, and before that, he was a general contractor, specializing in major renovations as well as new construction. He knows his way around buildings. In his presentation, John will be focusing on information that will come in handy when choosing a home inspector and offer tips you can use when you're out looking at properties. Information that could help you avoid investing your precious time and money in a property that may not be suited to your needs. Please welcome John Schiffer from Quality Home Inspections.
Thank you, John. Hi, I'm John Schiffer. I'm a registered home inspector with the Canadian Association of Home and Property Inspectors and Consumer Protection BC. Today I'm going to give you a few tips to use when viewing a potential property, but first a bit about home inspections. Why get an inspection? An inspection will give you a professional opinion on the home's overall condition, along with some technical advice, so you can proceed with confidence and avoid costly mistakes. A home inspection is a visual investigation of a property intended to reduce your risk. Until recently, anyone could call themselves a home inspector. Now all BC home inspectors must be registered with Consumer Protection BC. This ensures that the inspector belongs to a recognized professional association, meets the association standards, and carries professional and general liability insurance. What to expect of a home inspection? All the principal components are inspected, from site drainage to the mechanical systems. The time required to do an inspection is based on the size, age, and complexity of the structure, typically from 2 to 5 hours. It is not a guarantee or a warranty. The written report will be presented at the end of the inspection to be discussed with the buyer. The written report will include all the deficiencies and to determine the age and life expectancy of some of the components, such as the roof or the heating system. How do you find an inspector? By referrals through family or friends, realtors, mortgage brokers, or search online. Now, by making yourself familiar with some common and potentially expensive building problems, you can save yourself a lot of time and money, such as lack of maintenance, drainage problems, buried oil tanks, insurance coverage concerns, mold and toxicity. Some tips you can use when looking at properties. First impressions are very important, such as this house. I would say it's well maintained. This house, on the other hand, has not been well maintained. Excessive vegetation on the exterior is not good for the house and likely cause premature failure of the siding. This is also true for roofs. Vegetation and moss does not belong on roofs. Leaky condos are buildings built in the 80s and 90s. They failed due to lack of overhangs, poor waterproofing details at doors, windows, and balconies. All sidings are included, but particularly stucco. First impressions of this building, not well maintained. Leaky houses. Some houses built during the same 1980s, 90s period, especially stucco homes, had the same type of issues as condominiums, as you can see by the two leaks here, one from the roof, one from the exterior wall. A rain screen building can be identified by the horizontal flashing at every floor, as in this photo. Non-rain screen buildings lack this detail. They are more difficult to maintain, expensive to upgrade, and sometimes diligent maintenance is not enough to prevent them from becoming rain screened. Ceiling leaks in underground garages, if there is enough of them, can be very expensive to repair as well. When walking around the house, soil levels should be kept away from the siding and all wooden components, such as the supporting posts for decks. Older homes, in particular, when the drain tiles fail, may allow water to enter the basements and crawl space, such as this house. Basement leaks can show up as staining on the walls, also due to failed drain tiles. Stains on ceilings are caused by either a roof or a plumbing problem. Look for stains in closets in particular, as they are not well painted. This ceiling stain is due to a plumbing problem originating from the bathroom above. The most common room in the house to show water issues are bathrooms. This one shows an inspector using a moisture meter to determine how much moisture there is in the walls and the floors of the bathroom. Amateur work quite often results in all kinds of problems, in this case overheated wiring in an older electrical panel. Buried oil tanks, commonly found in older homes, can sometimes still be present today. The pipe shows the presence of an oil tank buried nearby. They are very costly to remove and are the liability for the vendor. Insurance coverage concerns. Outdated components can present problems when purchasing insurance for your new home. Older electrical knob and tube wiring, such as in this photo, some types of plumbing, such as polybutylene, and certain types of ungrounded electrical systems can be problems for many insurance companies, which might require the removal of some of these systems in order to obtain insurance. Asbestos was a common problem today and in older homes. It was typically used to wrap ductwork in heating systems, in drywall before 1980, in plaster, in some attic insulation, in old linoleum, and in exterior siding. Asbestos removal needs to be done by experienced contractors and adhering to strict safety standards. Mold, common throughout the house but can be quite common in attics. It is due to excessive moisture caused by either exterior leaks, plumbing leaks, lack of adequate ventilation. In this case, the attic mold is caused by inadequate ventilation and excessive air leakage from the interior of the house into the attic space. These are a few areas covered in an inspection. For more information, feel free to visit our company website at qualityhomeinspections.ca. Thank you for watching this webinar. I'm John Schiffer of Quality Home Inspections, wishing you all the best in your home buying adventures. And now back to John Charbonneau to wrap up your webinar.
Now that you found your first home, made your offer with the assistance of a realtor, secured the financing with a mortgage lender like me, and removed your subject conditions following a successful home inspection, it's time to turn over the process to the legal professionals that will make sure your real estate transaction closes properly. Our next presenter is Sean Hogan. Sean is a partner in the full-service law firm Buckley & Hogan, where they specialize in real estate, company, and business law, litigation, as well as wills and estates. Sean has over 2 decades of experience helping homeowners through the closing process, and he joins us now to take us through the legal process and demystify the final stages before you get your keys and move into your new home. Over to you, Sean.
Thanks, John. I'm going to review some of the legal aspects of buying a home. We'll review the contract, the types of ownership, terms and conditions, as well as the costs of buying and owning property, and the process of signing your purchase documents and getting the keys to your new home. The first thing we're going to talk about in buying a home is the contract. Your realtor will work with you to prepare the contract of purchase and sale. It'll look like this form. You complete this form to make an offer to the seller. The seller may accept, reject, or make a counteroffer. Changes are usually made by hand and initialed. When you and the seller have reached an agreement, the seller also signs a contract, and you have a deal. Let's look at some of the parts of the contract. I won't be discussing the price or the amount of the deposit, or those are things that you will negotiate with the help of your realtor. There are 2 ways to own property where there are more than one owner. Most couples will own property as joint tenants, which means that they own equal shares, and if one person passes away, the ownership automatically passes to the survivor on filing a death certificate. The other way to own is called tenants in common, where the owner can have different percentages of ownership. It could be 50-50 or 75-25 or something else. If one owner dies, his or her share does not go to the survivor, but goes to the beneficiary of the deceased person's estate. Either form of ownership can apply to 2, 3, or more owners and can be used in combination. For example, 2 couples can own property as tenants in common, with each couple holding their share as joint tenants. One of the first things you need to consider is who will be the buyer of the property. With the changes in 2016 to prevent assignments or flipping of the contracts, contracts now include a term saying that you cannot change the buyer without consent of the seller, which the seller does not have to give. So if you only put your name as the buyer and later want to add your partner, you may not be able to do so. This can be important if you need to have the other person on title to qualify for mortgage financing. In paragraph 3 of the contract, you can add subject conditions. These are conditions that you need to satisfy before you will commit to purchase the property. Common subjects are financing. Even if you have been pre-approved for a mortgage, your lender will want to view and appraise the property to confirm that it's worth the price you are agreeing to pay. You'll want the buyer to agree to give access to the lender's appraisal. Consider hiring a home inspector to go through the home and look for any actual or potential problems. Your realtor may be able to recommend someone, or you can find one online. Your realtor can provide you with a copy of the title to the property. It's common to find things registered against title, such as covenants, easements, and rights of way. A covenant, or permit as it's sometimes called, is a city's way of controlling the construction or use of the property. An easement is a right of use or access, such as allowing water to flow downhill or sharing a driveway. A right of way allows something to be placed in the property, such as a storm drain or a sewer line. You should review and understand all of these. If you plan on building, renovating, or changing the use of the property, you should check with City Hall. Most cities also have free online mapping, which provide a lot of information about the property that you want to buy. Sellers are required to complete a form called the Property Condition Disclosure Statement, which gives you information about the property, including whether there are any known problems. Review this carefully and ask questions if you have any. When you buy a property, the purchase includes everything that's attached. That includes such things as wall-to-wall carpeting, cupboards, and counters, but it does not automatically include things that are not attached. For that reason, it's common to specifically mention and include appliances, blinds, and window coverings. If there's something in the property that you want, such as mirrors or pictures, which are only held on by clips, then list it as being included. Similarly, the seller may want to list some attachments as excluded. The contract includes a term saying that the contents of the contract are the entire agreement. When you review any contract, you should consider both what it says and what's missing. If it isn't in writing, then it isn't part of the deal. So if there are any terms that are important to you, make sure that they are written into the contract. Next, we're going to talk about costs of buying. In determining your down payment, you also need to consider other costs of buying a home. When you sign the contract, you agree to be responsible for any taxes. The property transfer tax is a tax from the government of BC and is equal to 1% of the first $200,000 and 2% of anything above that. There are additional taxes of 3% if the price is over $2 million and 15% for non-resident foreign buyers. So if, for example, your purchase price is $500,000, your property transfer tax will be $8,000. There are some circumstances where a buyer is exempt from paying property transfer tax. One of the most common is for first-time buyers. To qualify, you must be a Canadian citizen or permanent resident, have lived in BC for at least 1 year, or filed taxes as a BC resident in 2 of the last 6 years, and not own land anywhere in the world that you used as your home or principal residence. You also have to move into the property after buying it and live there for 1 year. The full exemption only applies to property under $500,000, with a partial exemption up to $525,000. If the property is more than $525,000, there's no exemption even if you meet all of the other qualifications. The Government of Canada also charges GST of 5% on newly built homes, substantially renovated, that is practically new homes, commercial and recreational property. If you're buying a used residential home, there is no GST. If you're buying a new home worth less than $350,000, you can get a rebate of 36% of the GST to a maximum of $6,300. There's a partial rebate for homes worth up to $450,000, but no rebate for houses worth more than $450,000. You don't have to be a first-time buyer to qualify, but you do have to move into the home and live there for a year. Cities charge an annual property tax, which is due at the beginning of July each year. Although the tax is paid halfway through the year, it's for the calendar year. So if you're buying a home in the first half of the year, the seller will give you a credit towards the seller's share of the taxes, but then you will have to pay the full tax on July 2nd. If you buy in the second half of the year, you'll be reimbursing the seller for part of the taxes that the seller paid in July. Cities also charge for utilities such as garbage, water, and sewer. If you're on a metered water supply, you'll pay those around every 3 months. If you're not on a water meter, you'll pay those on March 31st each year. Depending on whether there's a water meter and the timing of the bill, there will either be a credit or a debit on your purchase for the city utilities. Lawyers and notaries are very competitive in terms of fees that they charge. In addition to the fees, there are a number of expenses such as land title office charges, searches, taxes, agent fees, insurance binders. Those fees and costs can range between $1,000 and $1,500 total. Many banks and trust companies which deal with properties across Canada also charge title insurance, which protects them in the event of a problem with the ownership. That fee depends on the value of the property and will be at least a couple of $100s. Credit unions, which only deal with properties in BC, do not usually require title insurance. If you're buying a strata property, such as a condo or townhouse, there will be fees to be paid to the strata which may be up to $200. The seller is required to provide additional information to purchasers of strata property. These typically include 2 years of the minutes of the strata council meetings, bylaws, and financial statements. Read them to look for past problems, previous repairs, special assessments, and any expected upcoming expenses. The contract will often include a term saying that if the strata declares any special assessments before you buy, the seller is responsible to pay. Make sure this term is included, but be aware that if an annual or general strata meeting is held after you buy, and the strata requires owners to pay a lump sum for special expenses, you will be fully responsible for your share. As of 2013, stratas with 5 or more units are required to obtain a depreciation report, which projects anticipated repairs, maintenance, and replacement over a 30-year period, as well as a financial forecasting of expenses. A 3/4 majority of owners can vote to exempt ordering that report. If the strata you want to buy has a depreciation report, review it carefully. If it doesn't, then you'll be relying on your review of the minutes and the report of the home inspector. Stratas operate by way of majority votes. That can work well in many cases, but in others it means a majority can create problems for other owners. You may want to talk to members of the Strata Council, other owners, and the property manager to find out if there are any internal conflicts or control issues which might negatively impact your use and enjoyment of your new home. Once you've the money to buy your home, you're going to need money for the cost of owning it. Make sure you budget for these ongoing expenses. These include monthly expenses such as hydro, phone, and internet. You also may be required to pay setup fees to start those services. There are also annual expenses such as the city property taxes, the city utilities, and insurance. You may want to make arrangements with your lender or the city to make monthly payments towards your taxes or utilities to avoid having one large bill each year. You may also have moving costs and the costs of buying furniture or appliances. When I bought my first home, we had to put aside money for repairs and maintenance. We had used appliances that broke down almost every 2 months. First the washer went, then the dryer, and then the hot water tank. Fortunately, we would just finish paying for one, so we had saved money to pay for when the next one broke down. We also made a list of upgrades that we wanted to do, starting with the bathroom. So budget for the unexpected as well as for any upgrades that you want to do to make the home your own. A fixer-upper can be very cost-effective if you're in the trades or have friends who have those skills. But be careful of buying a home that may need more work than you have either time or money to spend. Next, we're going to discuss what happens when you finally get to buy your home. When choosing any professional, it's always best to find someone who's recommended to you. Your realtor, family, or friends may be able to recommend a lawyer or a notary. Both are competitive in terms of fees for home buying, and you always want to have someone with experience. The main difference between a notary and a lawyer is that if a legal problem develops, the notary will not be able to assist you and will have to refer you to a lawyer. That said, there are very experienced notaries as well as very experienced lawyers who do real estate deals. Once you've removed subject conditions and the deal is binding, your realtor will send a deal sheet to your lawyer or notary with some information about the purchase and a copy of the contract. Your lender will likewise send mortgage instructions. Lawyers and notaries all use conveyancers who are specialized real estate secretaries. The conveyancer will contact you to get all necessary information and to make your appointment. The appointment is usually a few days before the completion date. You'll meet the lawyer or the notary to review and sign all of the purchase and mortgage documents and be able to ask any questions they may have. You don't have to meet with the lawyer or notary on the actual completion date. The transfer and the mortgage are registered at the land title office, and funds are made available for the seller's lawyer or notary to pick up. The seller usually gets their funds on the next business day after the completion date. For that reason, it's usually better to have a completion date on a Thursday or earlier in the week, so that on Thursday you become the owner, on Friday the seller gets their money, and on Saturday you move. You'll meet with your realtor on the possession date, who will provide you with a set of keys to your new home. The seller usually leaves the additional keys inside the home for you. You'll get 2 reports from your lawyer or notary after the purchase. The first is a copy of the registered transfer confirming that you're the owner, and you'll receive that in about a week. The second is a copy of the title, which may be a few months later, to ensure that the seller's old mortgage has been discharged or removed from title. Congratulations and enjoy your new home. Let's turn it back to John as we continue with our first-time home buyer webinar.
Thanks, Sean. Well, ladies and gentlemen, there you have it, your first-time homebuyer webinar. As you can imagine, there's a lot more information you're going to need to make an informed decision about buying your first home. Speaking on behalf of our presenters, we welcome your questions by email, and we will do our best to get back to you with the additional information you're going to need to make your first home purchase an easy process and an excellent investment. Best of luck in your home search, and don't forget to send us an invitation to your housewarming party. We'd like to join you and celebrate your first purchase.